Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media like we normally do. I share my opinions as we go through it, generally related to 3 different topics: wealth building, commodities, and or financial topics. So we're going to dive right in and take a look, see what people are chatting about. If you want to follow me at Finance, and if you want to join our community, finding-value.com, we go into all of these different topics. We talk about whatever people are willing to talk about during those question and answer sessions. We've talked about conference calls. We've talked about macro environment. We've talked about yield curves, yields, recessions, valuations, all sorts of things. If you are obsessed with trying to figure out the markets, much like I am, that's a good spot to hang out. We've got a coupon code. Special is the coupon code. You can save 50% off the first month only, and a larger discount on the yearly membership if you'd like to switch from a monthly to a yearly or directly to the yearly. So coming down, we got James E. Thorne. Would a decline in energy prices offset the one-time price hike caused by tariffs? His answer is yes. Crude oil going to $50 WTIC and gas at the pump going to $2 a gallon. What's more important? What I'm going to say is an opinion that's going to follow this. I don't think there's any chance at all, like 0% chance that we can stay at $50 for any length of time. We are going to see production decline, shale production decline. We are probably going to see offshore hurt too. The break-evens in some of those areas are $80 or $90 WTIC. It's 70, 75 for some of the higher cost areas in shale. We're already seeing evidence before this pullback in the 60s, before this. So in the 70s, we were pulling back on rig count. Our drilled uncompleted wells are declining. Now, I am not saying that $50 is not possible in a high fearful event, everyone's selling, liquidating everything. That is not what I am saying clearly. So if tariffs do go through, I don't think that $50 WTIC has any chance of going there and staying there for any length of time. Length of time being over a year. I think that we could see a dramatic decline in supply already at the prices that we're already at in the future. Projects will be delayed. Drilling will pull back even further than what it has, and I don't think that's possible. Now, there are some people shorting oil because it's broken out of this trend here. So this is the consolidation. We entered this consolidation, in my opinion, from the downside up. We consolidated. Here's your consolidation. And now we've got a false breakdown. I can't tell you exactly where this will go and how low it will go. I'm in the camp that if it does break, it will be a false breakdown, and we won't be down here for a long period of time. Maybe measured in months. I don't think it will be measured in years. So if we pull on back, people are going to get short. This is what a slingshot cheetah is. We'll just describe it here real quick. People see the pattern that it's broken. They don't understand the fundamentals, so they go and they short it down here. They try to short it, and then price reverses on them and slingshots to the other side because the fundamentals justify a move higher, not lower. In the short term, I don't know which direction it will necessarily go. We've got lots of uncertainty and fear in the market, and it very well could go lower. I'm not debating that. The bigger, longer-term view, if I were to yank out, I'm going to go to U.S. oil that has a lot more history and data. And then I'm going to do this so it's easier to see. So when I look at this, this is kind of my go-to chart for the long term. Again, we've got consolidation, breakout, consolidation, breakout, consolidation, breakout. And I think we're going to go all the way to the upper end of that. What's going to cause that move? Well, one, the technicals. The technicals in the short term, yeah, they don't look that great. Longer term, they look fantastic. The valuation, number two, the valuation, oil has never been, well, not never. It's the second cheapest time in history. C19, it was a little bit cheaper, went negative. Now, in a fearful event, I don't think we're going anywhere near C19. That was a complete shutdown, and people didn't know what to do with oil because they can't stop the production of oil. I think the circle is roughly where the circle is right now. This was 9/11 event. That was 9/11, and maybe this is the tariff event, question mark? I don't know. But to me, it looks like that's the situation that we are in, and that we will eventually work our way on up to multi-$100 oil out in the late 2020s. How can we get that high? Because we've got a supply problem, period. There are supply problems coming out in the late 2020s that I don't know if we've got the oil to produce. And that's going to send gold and silver to the moon because currencies and bond markets are going to come into question because they're just pieces of paper that are garbage. It says the banks are in huge trouble. Something is horribly wrong for the banks starting January of 2025. Their silver short contracts are looking to be in big trouble. On March 14th, the shorts were 24 million plus contracts. On March 31st, up another 4 million to 28 million short contracts, approximately 20 times greater than any time in history. With the start of April, they crashed silver $5 to only get their short position down to where it was 2 weeks ago on March 14th. The banks are in huge trouble. So let's describe the situation here. The banks, a lot of these big banks, are massively short silver in the paper markets. As the price goes up, those shorts go underwater. We've been going up quite a bit in the price of silver. The banks are going to start to have problems because they are massively short silver. And if the price keeps going up, well, that's going to show up as losses if they try to take it off the books. So this is going to be a huge squeeze. It could be a gigantic short squeeze at some point. Could be the case. Could this tariff information or news that was released, did the banks jump on this to basically hit silver, platinum, palladium, gold to the downside? They very well could have. A lot of the market movements, if you look, they're done in post-market and pre-market. So if I were to go to candles, and then I go to like a 5-day, blow this up a little bit. This is like this movement here is the market. This is post-market, pre-market. You can see we were going up, and then all of a sudden the news was released up here, and they just shot this thing as far as they could. We went sideways and then shot it again, pre-market and post-market. So my question is to all of you, if you held a lot of silver and you needed to offload a lot of silver, would you do it during market hours where the volumes are high, or would you try to offload it in the aftermarket, post-market areas? Well, you do it during the day because that's where all the volume is. Then what's up with this? Why didn't it go down during these open hours? I think they're doing it on purpose, is what I'm getting at. It doesn't really matter. Take advantage of these pullbacks and get the silver that you need. That's what I'll say. William Middlecoop says, Paul gets it. Silver's an incredible bargain. Of course it is. Look where the ratio's at. We're at 100-to-1 ratio. For those concerned about the silver pullback during this pan sell-off just means everything sells off. Consider how much time the gold and silver ratio has spent above 97 since 1932. This little spot, that little spot, and this little spot that we're at right now. That's it. That's the time it's spent there. Very little time. This is an opportunity, total opportunity for these ratios that are just completely out of whack. Platinum's another one that's completely out of whack. Would I buy it? Yeah, I would load up. Now, do I have a ton of money at this exact moment to go out and buy a whole bunch? A little bit, but not absorbing amounts. It was already cheap to begin with. So I've been accumulating a lot of different undervalued assets, but that doesn't mean it can't get more undervalued. If the conditions persist, maybe it gets to 110. Maybe it doesn't. But I would say this: we are closer to a bottom than we are a top. So that's the way I would look at it. Brian Sullivan says, just spoke with a mortgage broker who said we could see 5.5% mortgages soon, depending on credit score and amount borrowed. Macro economy, jobs, confidence, etc., a concern, but we are definitely seeing tumbling mortgage rates. We have seen that. Now, what I'm going to look for is I'm going to look at home sales. As these mortgage rates drop, if you're in a recession, home sales would go down with interest rates. If you're in a bullish market where you still have, say, too many buyers and not enough homes, and mortgage rates drop and home sales go up quite a bit, you're in a bull market. So that's what you want to watch for. That's what I'm watching for. Ian Castle says, to be right in the long term, you must be willing to look wrong in the short term, and that's buying at really cheap locations. I don't think you have to be wrong in the short term to be right in the long term. I don't think they are like there's any. You can be right in the short term and you can be right in the long term. But a lot of the times, if you're trying to catch bottoms, you will look wrong in the short term, but be very right in the long term, as long as the valuation is at your back and the conditions swing back into favor. That is completely right. But that's not. You don't have. In order to be right in the long term, you must be willing to look wrong, and willing's the key word. Willing, and that's only because all the narratives are going to go against you. Everyone's going to say, "Why the hell are you buying platinum? Hasn't moved in 14 years. Why are you buying silver at a ratio of 100 to 1? Gold's outperforming. You should be buying gold." That's the FOMO crowd. So in order to be right long term, you must be willing to look wrong to other people in the short term. And you have to be patient. And then when let's just say, hypothetically speaking, silver goes to a ratio of 20 to 1, and it's at 100 to 1 right now. You just 5x gold. So that means that the money that you put in today in silver would 5 times your gold holdings versus putting money into gold. If that ratio were to get back to a 20 to 1 ratio for easy math. Jim Bianco says, if tariffs are being used as leverage to negotiate favorable trade deals, market damage is overdone, and that's art of the deal. If tariffs are intended to be a lasting source of revenue, the market moves are justified. Trump suggests they are both at the same time, creating confusion. And that is where this is where it gets really, really difficult. Because now he's signaled that, he's using it for a potential negotiation tactic. At the same time, they might also be lasting, but if they negotiate, maybe it's not as bad as we think. We don't know. Ultimately, it's uncertainty. Markets don't like uncertainty. So if he were to yank those tariffs away, the markets would surge higher. If he keeps them in, but they are negotiated lower, perhaps it's not as bad as what maybe some people think. Maybe they're pricing in the worst case scenario. Maybe that move that people are shorting in oil creates a gigantic slingshot cheetah where it runs to the upside like we've never seen before because all the shorts are going to have to cover too, and everyone is offsides. They're not positioned correctly. And this is where the uncertainty comes into play. I can't tell you what's right and what's wrong here. Are the shorts right because a worse outcome and maybe a recession comes? It's possible. That's not what we see in the data yet. So they're early to make that call. And it's a tough one with the uncertainty around, is this permanent or is he going to lift it? Don't know. Logan says we have experienced numerous recessions, corrections, and a few bear markets in stocks. But there's only been one national nominal price crash, period. Normal Americans don't act like middle-aged men, podcast stock traders with their homes and running theme of the nerd tour. This is going back to 1942, and this is all the up years that home prices have experienced. There was one -1% down year in 1990. 1990 was a hypersupply phase of real estate, and it went down 1% nationally. The only time in history that we went down nationally was from 2007 to 2011. And it wasn't like a 30%, 40% all in one shot crash. It was -5, -12, -4, -4, -4. So it did leak off for a few years. But that was a huge deleveraging event. That was all a bunch of crappy loans put into the system, foreclosures, short sales. There was all sorts of crap coming online. And on the back end of it, your demand is horrible because you gave loans to everyone before it. So everyone who could get a loan qualified for a loan. They all took loans. They gave the homes back, and then you had no buyers behind it. So that's what happened in the 1920s. They gave a whole bunch of loans in the 1920s. They all went bust late 1920s to 1930s. That was the depression. That was the problem. It was a large deleveraging event in the real estate market. We had two instances, the 1930s and late 2000s here, 07, 08, 09, 2010, and 2011. Those are the two instances that we saw pretty large declines in real estate across the board. Now, I'm not saying that some cities didn't go down. I'm sure there's cities that have gone down already here in terms of timing. And I'm sure there's been, it seems like California and Arizona have big boom and bust cycles too. So yeah, there's going to be local maybe busts, but looking across the board, home prices don't fall 30% in a year. And this was in response to someone saying, if stocks keep falling, good luck with housing. I mean, these people just don't know anything. They don't know history. And there's a lot, even on YouTube, that pretend to be housing experts. And I'm like, dude, you are pushing it here. You don't have the sellers, at least not yet. QE Infinity says, this is being reported by several news sources. If Besant wants out, it's time to panic. He was the only adult in the room. Says top Trump official so freaked out about tariffs he wants to quit. I have no idea if this is legit news or not. But I can understand that he's probably getting a lot of pressure because of the markets. But I also don't think that they caused the necessary extent of the crash. I think the market was already rolling over, and this just kind of pushed it over the edge. You know, the this is Sparta kick, like they just kind of kicked him over the edge, and then it was, the situation was already at the ledge. It was already ready to jump, and they just kind of pushed him over the edge there. That's all. Gold to SPX ratio, oil to SPX ratio. So these are some ratios that I look at. This is gold to SPX. SPX is the S&P 500. GC1 is gold futures. We're starting to break this downtrend. I know it's kind of hard to see, so I'm going to zoom in, and there's the breakout of that downtrend there. So we're breaking out of the first kind of downtrend of the ratio, gold to S&P 500. Then we're going to break this horizontal next. That's the next one in line to break. This is U.S. oil divided by the S&P 500. You can see huge periods, 1914, 1915 out here, gigantic move in oil versus the S&P 500. Another gigantic move in the early 70s to 1980. This one here was peak oil in America of conventional oil. This one here was peak oil of the world, is what they're saying for conventional peak oil world, all world. And then shale came online, pushed it back into this corner here. The corner is where we're at today. What does this mean? There's a couple of things that I want to show you on this chart. We could be in a corner. We're squeezing into a falling wedge that's bullish to break higher. I took the fractal. The circles are fractals where you have this lead-in pattern, lead-in pattern, all getting sorts of funky up in this way. I think we could even outrun what the fractal I have here is potentially. I took the 1960s and 70s fractal, this guy under here, and overlaid it. You can't even tell the difference. There's the zoom in of the fractal. It's the same damn thing. Now, in the very short term, does that mean that we can't go lower? No, it doesn't mean that we are just going to go straight up. At some point, though, gold already did a run forest run right on front of us. So here's gold. We'll do XAU USD. This is what gold's done already. That. You know what goes next? Oil. Oil will go next behind it. So the money's in the system. The money's been created. M2 money supply is going back up. Gold's accounting for that. What comes next is oil. Now, in the short term, if we still have a fear-on event, there's nothing I can do about that. Can't control fear or anything like that. I mean, people will panic. They could sell everything. It's a pan sell-off is what they call it. Here's Lennar long-term chart as a proxy for housing. I just took it because it had data. And then I did a fractal overlay on today from the last breakout. But look at how similar this is. Shoulder, head, shoulder, breakout, consolidation, breakout, run. Shoulder, head, shoulder, topping pattern, going into an inverse shoulder, head, shoulder, bottoming pattern. Breakout, just like 1970s and 80s, breakout. Then they broke out of this consolidation resistance level. And then I took this fractal and overlaid it right on top of what we're doing now. It's got the two hump, and then we could go all the way up and maybe we do another shoulder, head, shoulder in like 2029 and 2030. Maybe. I mean, this isn't perfect, but the fractals all match up of this over and over and over. And this is a driver of the commodity bull market. All these bull markets occurred. A lot of these bull markets occurred when housing was going up, which is inflationary. U.S. construction data. Why do I share this? Because a lot of recessions occur, and this is a leading indicator. So all employees construction, it's still going up. The previous markets like C19 is here. This big pullback is 2007-8, and then it bottomed in 2010-11. We had a small pullback here in 2001. We had a pretty decent pullback in 1990. Here's another recession in 1980, mid-70s recession. We had a small little recession here early 1970s and here late 1960s. We had these small kind of corrections. This is a big boy here. That's a big boy recession there. But we haven't turned over yet. Doesn't mean it can't. I just don't see it yet. And this generally turns over if we get a recession. But if they're lowering interest rates, you want to watch housing starts. Because if housing starts and home sales start to go back up, it means activity is picking back up. This was housing starts, and you can see when they drop below this white line, these are mainly all recessions. Recession. They're all recessions. This one here, we had a recession that was kind of mid-cycle here. This was 2001 right here. We kind of have a similar situation to today. And we've broken to the upside of this little pattern that we've got here, which is very similar to 2001. So is the recession behind us? I don't know. No one knows that information. But this is what it looks like right now for housing starts. And housing starts is a big deal because that's one of the leading indicators. This is producer price index for all commodities. This is a long-term chart. So we've got these large inflationary breakout periods. We had one in the 1940s. So we had hump 1, hump 2, hump 3, and then we broke out. 3-hump consolidation. We have another 3-hump consolidation, 1 hump, 2 hump, 3 hump. We've broken out to the upside, and we're starting to turn up again. The three areas was early 1940s all the way till 1953. We consolidated from 53 to about 1968, 69. We broke out again, running all the way up to early 1980s. We consolidated upward on this one here from the 80s, 90s. We had another large breakout in 2000, 2001, big move up, and then we consolidated again, and we've broken to the upside. Could we be located like in the 40s here, like mid-cycle before we have another big inflationary move? Very possible. This is history. Stocks do real well in these consolidations. The blue areas is when stocks go incredibly well. Bring back American manufacturing. Bro, you're about to lose 10% of U.S. oil production. You are, actually. If we lower oil and we keep it there, you are going to see a massive decline in oil. Then prices are going to have to go back up. They're going to have to go back up if you want to bring on more supply. And I think we're going to set up a super spike here. Because if they do hold it down for any length of time, it's going to spike like heck to the upside. Here's more information from Christine. She says, U.S. FRAC spread count is -4 week over week and -52, 20% year over year. So this is already baked into the cake, guys. $50 oil is like leagues below where we need to be. We need 90 to 100. We were cruising around 70s, and we're dropping FRAC spreads massively. We're dropping all sorts of stuff here. This number is more important than rigs in the U.S. as it speaks to near-term production. As this count falls, so goes U.S. supply. And there's -52 for total FRAC spreads year over year. That's horrible. We're setting up for a gigantic move to the upside. And people are going to go here and short it. They're going to short oil here. Good luck. I mean, they might work if the fear remains in the market. If it leaves the market, though, or if Trump changes his mind on the tariffs, maybe not change his mind, but what if he gets favorable negotiations and the tariffs become basically they're nothing, a nothing burger, we'll call it. We could see a huge move up in oil. It's possible. Now, am I saying in the short term that that's going to be the case? I don't know the outcome. No one knows the outcome. Trump's the one that's doing all this stuff, so I can't tell you what he's going to do. If the fear remains in the market and he keeps the tariffs on and things get worse and there's trade wars, then yeah, we could see way lower oil prices. That's totally possible. Return to normal. I thought this was a good chart. This is NVIDIA from 2018 onward. You guys noticed the pattern. So this is the smart money, institutional investors, and then the blow-off public top. And now we're starting to come back down. We'll probably get a surge higher at some point, a pretty big bounce. People are going to buy back into NVIDIA, and then they're going to get absolutely. It's going to be a bad move after that. A very big move. Generally, the first move lower is the sharpest contraction move. So this is where you get those fear and margin calls and people get scared. It's that first move lower. Then you get a huge bounce because people are going to short it too early. So you're going to have short covering and other stuff as it bounces back up. This is the return to normal area. And that's where people are going to try to, it's called the bull trap. You're going to set the bull trap. It's going to go way down and people are going to get ripped on this. That's the cycle we are in. You guys obviously know, I've said many times that this is probably going to roll over at some point. I was saying that from 2021 onward. So I was a little bit early. You can see 2021 was actually back here. So I was early on that timing. What I thought was going to happen is that we were going to get this rollover, which occurred in 21 and 22, and that we weren't going to get this last kind of blow-off move. The reason I thought that is because commodities were bottoming in 2020. We were starting to gain momentum, and interest rates were going up. But there was a bigger move on the backside here than what I thought was going to be possible. So I didn't get the timing right. I wasn't in any of this. I've been in commodities. But I did not get this top here. I thought we were going to roll over here get a move up and then roll back down. But we had a blow off top where, yeah, I didn't get it right. I'll just say that. QE Infinity says this is good and explains a lot about what's going on with tariffs. $1 trillion in debt needs to be refinanced in 2025. Who knows how far this administration will go to get the 10-year yield down? They will sacrifice the equity market to get it done. That's clear. That is true. But the equity market was already rolling over, in my opinion. Could it have been from tariffs? I don't know. I think they're kind of screwed, though. That's what I'll say. They being the governments and stuff like that, because they've got a lot of debt they got to roll over. And, I mean, it's just going to keep coming. So it's a tough outcome. Green housing market is above pre-pandemic 2019 levels, and then brown is the housing market is below the pre-pandemic 2019 levels. So you can see most of it's brown. There are some green spots, Florida, Texas here. There's some located, say, Arizona. This is Utah here. We have some in Utah, a little bit in Colorado there. New Mexico's looking pretty brown. It looks pretty brown in the summer, to be honest. A little bit through here, too. Looks like we got our Oregons, our Washingtons, and Idaho right through there. The Crude Chronicle says, with an absolute obliteration day of oil field services, they are now pricing in a 30% reduction in completion activity, in his opinion. What does that do to the supply-demand imbalance? So what this is your oil field service index and U.S. oil well completions. We're down to minus 30%. Now, we were down there from minus 70%, minus 50 in 2020. We hit this low in 2008. We had multiple lows of where we're at today, 2016-ish, 2012. We had another kind of low where we're at today, roughly in 2001, which was another recession. The bottom here was 2000, 98, 99, 2000 here. Another bottom that was down at minus 50%. And then we have to go back quite a ways to get back into the 1980s. So these were all kind of post-recession. Could this be a post-recession move that we get? Very well could be. Maybe we already went through the worst part. Maybe we haven't. No one knows. We can look at yield curves. We can see what they're doing. They're kind of staying higher, to be honest. Usually when you get a move lower like this, you'll see the 2-year drop like a rock. It's not dropping like a rock, which is kind of, it's not concerning. It's just, it's weird. People are not running to bonds for safety. And that's where we're going to end it, is right there. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Special coupon code if you'd like to join. But that's all I've got. We just recently did our Q&A session, so everything's uploaded to the website if you guys want to check that out. All right, guys. We'll catch you next time. This is Finding Value.